So what is a rental property loan? All right, guys, it's Phillip. And so a rental property loan is a first lien mortgage that's secured by a single family residence that's actually occupied by a tenant, not the owner. Okay, so the property must be ready to rent to qualify for a rental property loan. And the tenant is usually for a long-term period, but rental property loans can also be used on short-term rentals, vacation rentals, Airbnb. You know what I like to do. So rental property loans versus conventional home loans is what we're going to talk about today. Lower maximum loan to values, LTVs. Rental property loans typically require much larger down payments. Therefore, it's a good idea to budget at least 20% for the down payment plus closing costs. So you can expect that to be anywhere from 20 to 25%. You're also going to require to have a higher reserve requirement. So you need to expect to show that you have liquid cash reserves equal to your down payment and your closing costs, as well as 6 to 12 months worth of monthly principal, interest, taxes, and insurance. And then any association dues like homeowners associations. Some lenders may even require for you to prove that the reserves on firsthand for your other properties that you already have financed as well. So other rental properties as well. The other downside is that the interest rates are higher. So rental property loans typically have higher interest rates and higher fees. They should be 100 to 400 basis points higher than an owner occupied property. So just to explain further, 1/100% is equal to 1 basis point. So if a home loan on an owner occupied property is, for example, 4.5%, which we're seeing like 6% right now, but at 4.5%, then the rental rate loan would be like 5.5%, so 1% higher. The other thing too that you have to keep in mind is you're going to need documentation. Okay, so you'll be asked for employment history and more on some types of rental property loans, especially if you already owned other rental properties. However, instead of focusing on your personal employment and your personal income, the lender will focus on the rental property cash flow, okay, for these types of rental loans. So that's basically what we call DSCR. It's a debt serviced rental loan, okay? So that's what we look at. This greatly simplifies the documentation as well. So two financing options exist for rental properties. You can get agency loans, which is like Fannie Mae, Freddie Mac. So you have to have, as a borrower, you typically have to have a 660 or a 680 credit score and a net worth of at least 100% of the loan amount, excluding your retirement accounts. You should also have at least 10% of the total loan amount in liquid assets. And these are not hard and fast rules, and exceptions can be made, but mainly if a compensating factor such as lower leverage exists, borrowers with multifamily ownership or management experience are also preferred by lenders and agencies, though this is sometimes negotiable depending on the specific deal, okay? However, there are still some drawbacks, and here are some of those in bullet points. Some substantial documentation. You have to have a lengthy and uncertain underwriting process with substantial reserve requirements that increase with the number of loans outstanding. So basically, the more mortgage rental properties that you own, the more cash reserves that you'll need to have. The down payment requirements that increase with the number of loans outstanding. So the more mortgage rental properties you own, the more you must put down for each new property. And then there's also the restrictions or cash out refinance. Okay, so restrictions on cash out refinances, and then the inability to borrow in a legal entity to protect your other assets and identity. So a lot of times you have to move these properties out of your LLC or out of a legal entity structure and put them into your personal name. The other thing too with these types of loans, it doesn't matter how good you pay. If you pay on time, everything's going great, and the property's secure with a good equity position, eventually you won't be able to get more of those loans. They'll cap you out at like 10, okay? So the other option is looking at bank loans, and banks can be more flexible on underwriting in exchange for higher rates and fees because they plan to keep those loans in-house rather than sell them on the open market. On the other hand, banks cannot portfolio 30-year loans. so they can't make a 30-year amortization schedule. They'll usually write it up with a 15 or a 20 or a 25-year amortization schedule with like a 5 or a 10-year balloon or a 5 or a 10-year adjustable rate mortgage. So every 5 or 10 years, you have to redo something with that mortgage. So it makes you feel a little uncertain because who knows where interest rates and things are going to be, both in the economy and in your own personal finances, right? So having to worry about what am I going to do in 5 years, 10 years when those balloons or those adjustments come into play. So definitely keep that in mind with the bank loans, okay? And that's something to consider. Also, there's a lot of exposure in the limits, and typically that means an investor will have to line up multiple local banks to finance a good-sized portfolio. There's the uncertainty in that local banks often change direction quickly in response to their most recent regulatory reviews. This means that they might be in the business of financing rental properties 1 month and then the next month they're not, right? So again, 5 years from now when they have these balloons or these adjustments, what if they're not doing these types of loans anymore? They can just force you to get an alternate way of paying them off, call the loan due, make you refinance with somebody else. So local banks aren't set up operationally to originate mortgages in high volumes, and they tend to work a lot slower as well. So the question I get asked all the time is, how do I qualify for a loan? So the first thing that you're going to want to do is you're going to want to calculate the approximate down payment amount. And like I said before, you should budget at least a 20% down payment if you're purchasing a house that's turnkey, ready to go. If you have excellent credit, you may be able to get it for like 15% down, but honestly, in today's market, it's going to be in that 20% down, plus expect, like I said, to have the money for the closing costs on top of that. If your credit isn't that great, you might need as much as 35% down. So credit scores definitely help and affect the amount that you can borrow, the interest rate that you're going to get approved for. So the other question is, I get all the time, am I financially ready? So you also want to plan on having 6 to 12 months in liquid reserves in addition to that down payment. You also might want to consider increasing your credit score. It's always good practice to pay your bills on time. But for those of us that don't realize how obvious that is and what common sense that you need to pay your bills on time, the higher your credit score, like I said, the better your interest rate and your better your chances of actually getting approved. So you can also implement different things between now and when you're ready to get your loan for an investment property to make sure that you're working on your credit, get your credit fixed up, and pay your bills on time. So that way you have a strong credit score and you can have a smooth closing process. You also want to demonstrate that you have qualifying income. So if you're getting these bank loans and these Fannie Mae, Freddie Mac, you're going to have to prove your income and prepare your documents. So if you're applying for a loan from an agency or a bank, you need to make sure that you have your pay stubs, your tax returns, your W-2s, everything that's required, and then prepare your answers and be prepared to answer questions from your previous 2 years of your taxes. Also, you need to ensure that you have enough personal income, including any net operating income for your rental properties, to cover your rental property monthly payment. You also need to make sure that the property that you're trying to get the rental loan on is rent ready. So that means there can't be any deferred maintenance. You can't be doing a renovation on the property. It has to be already fixed up. My favorite way of buying houses is buying houses below market because they need to be renovated. So I do a 2-step process myself personally when I'm purchasing properties. I'm looking for off-market properties that need to be renovated that I can buy below market and then fix it up. And then I'll refinance into one of these permanent loans at this 80% or 75%, sometimes 70% loan to value. So the cheaper that I can purchase that property on the front end, the less I'm going to need out of pocket when I do my refinance. And my goal is to do as little or no money out of pocket. And by doing some different strategies that I teach, that's the goal that I help people create for their own investment strategy. So again, the property must be rent ready. Construction is financed separately. That's going to be with a hard money loan or a private money lender, or if you've got the means, you pay cash for the property, fix it up, and then get your loan after that. Finally, it's a given that there's always going to be frequently asked questions, and you can search the internet and you can look for the frequently asked questions to find out more about rental property loans. But of course, they vary on location, they vary on property type, they vary on property values. There's a lot of variations that you really want to take into consideration. And you might need to have somebody like me to help you and guide you and personally mentor you to give you the answers to your specific questions to help fill your specific needs, because everybody's situation and location is different. There's no one size fits all for anybody. I can give you next step guidance and help show you the ways that have worked for me, the ways that I believe will work for you, and then help guide you through that. So consider all of the parameters that we've talked about today and figure out what type of loan that you need. And maybe you can't put a 20% down payment. Maybe your credit score might be too low and the interest rates would be too high. I'll show you how to make ends meet depending on exactly where you're at. A lot of the people that I work with are starting out small and then they're gradually building up to what the dream is, that we can buy as many houses as we want to create financial freedom. But everybody starts somewhere. Everybody starts not knowing a thing. Everybody starts with money or without money, with good credit or without good credit. And it's my job to help you navigate all the different options and availability processes that are available to help customize a blueprint and a map to help you get on your path to financial freedom. You see, I've been in real estate now for over 2 decades. I'm your guy, and real estate investing is the way I have created my financial freedom. And it's the way I want to help you create yours and help you get started in real estate or help you take your real estate investing business to the next level. You can't expect to get to that next level and reach your higher goals doing the same thing that you've been doing. And the things that got you to where you're at now will not get you to the next level. So let's work together. Talk to me, find out what's a good time for us to connect and see how I can help you. And I can also turn you on to the loan products that I have available that will fix all of these problems that we just talked about today. So if you're ready to get to the next level, I'm your guy. Let's work. God bless you guys. Thanks for watching. Go out there and make it a great day.